Is it now time to sell DraftKings stock? They brought the Q3 earnings out yesterday and the stock market reacted really badly to them as the stock was down 27%. And today I'll share with you guys what I have found in these filings and if it deserved to be down 27%. So I've gone through the conference call about 3 times. I've gone through the SEC filings about 3 times. And I want to just share some of the information that I found out from that quarter and if it was as bad as that share price was or reacted to with these earnings. So obviously the stock sold off massively, and the weird thing about this sell-off is this sell-off started, but when the earnings came out, the stock was basically flat for a long period of time. For a good 5-10 minutes, the stock didn't really react to the earnings, and then it slowly trickled down 3%, 5%. Within the next kind of half an hour, we were down 7%. Then we ended up going lower double digits, and then the more we kind of went on, by the time the market opened, we ended up being down 27%, and it just was from when we reported earnings to when about 3 o'clock, it was like 3 hours of the stock just going lower and lower and lower down, which is really weird to see because normally when you bring earnings out, you normally get that kind of instant reaction of shoots up, shoots down. And for DraftKings, it really had this weird thing where it slowly dropped lower and lower through the day. And towards the end of the video, I might say why I think that could potentially have happened. So weird reaction on the share price automatically. Now, if we look at the earnings, first of all, EPS beat, revenue beat, and then they guided higher. So we had DraftKings come out with a triple beat. Now, to be coming out with triple beats in this economic time frame is pretty impressive. And normally when you have triple beats, that is something special. You know, you can get the EPS beat, you get the revenue beat, which was absolutely insane. We'll touch on that in a second. And then you guide higher. Triple beats are normally rewarded with share prices going up 10, 20%. So normally when you look at this point of view, you think, okay, this is really positive, but it wasn't rewarded with a 10 or 20% jump in the share price. It was rewarded the other way with a over 20% drop in the share price, which is the first kind of weird sign that we saw from these earnings. And then what that led to do is because the stock was down 27% on the day, a lot of the media sites were going, okay, the beat EPS, the beat revenue, the guided higher. The stock's down 27%, and that led a lot of media outlets to kind of try and justify a reason for the drop to be down. So if you had a look at Seeking Alpha went with the headlines with great numbers from DraftKings, but it's down because of weak guidance. And then you looked at something like a CNBC who said that that DraftKings dropped because they said that they could potentially be affected by some sort of slowdown, which wasn't even once mentioned in the earnings call or conference call. In fact, the only thing that they said is that at the moment we're seeing no impact from the economic environment that we're in. So they actually said the total opposite, which CNBC said. And then when we look at Barron's, then Barron's went with the headline, oh, it's dropping because monthly active users were a little bit weak. So all these media, and there was a few other ones out there, that even the media were looking at this going, DraftKings just beat EPS, revenue, guided higher, and then it's down this much. What we're going to say for the reason why the drop is, and that was clear in the media. Even the media were trying to find the reason why they dropped, and that's why there was multiple different headlines. There wasn't the headline of, it was clear that the stock dropped because, oh, they missed EPS, they weren't profitable as what they should be. Oh, they missed revenue, you're supposed to be a revenue company. You missed revenue, that's why you're getting killed off. Oh, your guidance is weak. Obviously, they're starting to get affected by that economic environment. There wasn't anything concrete even for the media outlets to pick up, which was another kind of like, okay, this is really weird what's going on with DraftKings today. So let's have a look at what went on with these numbers. So first of all, EPS. The EPS came in at negative $1, and this was compared to the analyst expectations, which was negative 1.04. So they beat on the EPS. Now, EPS isn't a big thing for me. I'd rather them still focus on that growth story, taking market share. But having a good EPS beat is obviously great. And the thing is DraftKings have had a 50-50 history with the EPS record. So coming in here strong is great. And that's what DraftKings came in. They came on with a good EPS beat. Now, obviously the key thing, the one key number, first number that I have to look at in DraftKings, because it is a growth stock, it's a growth company. We want to see that the growth is still going. And it happened. 136% revenue growth. I'm going to say this one more time. 136% revenue growth. This was compared to expectations of 97%. That's correct. unbelievable. I've seen DraftKings pull out some serious beats on revenue. I don't think I've seen it do this before. This was unbelievable good. Now, they did say that some of the reasons why this was a lot better than what was expected was because of the hold rate. We've been saying this a couple of times before going into earnings. If you go check my last videos, I've been saying that the data at the moment suggests the hold rate is going to come in the stronger side, and it did happen. And they said that on the conference call. They said, look, one of the big reasons why we did have so good earnings is because of this hold rate this time round, and that really helped the numbers. So that was good. And let's look at the guidance. So the guidance at the start of the year was 1.9 billion. They delivered, or they're going to say they're going to deliver now 2.175 billion in revenue, and they hiked the midpoint of this revenue up as well, which was really good. So very much like last year, they beat expectations and hiked up through the year. They're doing it again this year. The revenue is a lot higher than what was expected. Now, this is the key thing. We were obviously hoping for good revenue beats. That's the main thing. But now what we're starting to see is the profit or the losses are moving to that profitability. You're starting to see the signs now. So adjusted EBITDA losses were supposed to be in 875 million. They have now moved that to 790 million. So that is a massive improvement of what we were expecting, and they continue to hike that up. So yeah, great numbers, more profitable quarter or less losses than what we were hoping for. Their revenue obviously smashed it, and now the guidance is hiked up and the losses are coming down, which you want to see. And now that push to profitability begins, and still keeping up that growth story. They then gave forecast for 2023, which I thought was really surprising to see them actually do this early. Normally you would expect to see that in Q4, but they did decide to guide for 2023 this year. Their guidance was revenue growth of 33%, which obviously is still fantastic growth. The growth story is still very much there. And that was against the expectations that they're going to grow 30% in 2023. So the expectations were higher than what is expected by the market. So the guidance for 2023 was once again ahead of expectations. Now, it's worth saying that management did say once again in the conference call, this is once again quite conservative, as you know from us. We've seen it in 2022, conservative on the guidance. They beat it. We saw it in 2021. Conservative with the guidance to beat it. So that suggestion there, I would expect them to be a lot higher than that growth. I would like to see them still push into that 40% growth range. So we'll see what happens there. They said that 2023 EBITDA of losses of 525 million. Now this is great, because what we want to see now is this has been the big point of expansion for DraftKings. Now what's going to be the key is DraftKings say they're going to hopefully have at least 10 contribute profit states. Now that's key wording, because we've not seen at least before. The target has been 10 contribution profit states, and they use the wording at least coming from this year closing off. So that is really positive. And now they're starting to get more mature. They're having more states that generate profitability. That's going to start funding company. Also, they're saving a lot of costs now because they're getting larger. Marketing spend's coming down. It's cooling down. They're allowed to do more national advertising rather than advertising through states. We're starting to get to the key point. This was always being said by management. This is now the key point where the losses start coming down. And we saw that in this quarter. In fact, we start to see it last quarter. We saw it even more in this quarter. And going into next year, the next 12 months, we're going to see that bringing down massively. And you can see here, we're walking away. This year we were supposed to have 875 million in adjusted EBITDA losses. It moved down to 790 million. Going into next year, that's going to move down to 525 million. And the key thing is what they included in this guidance is new state launches. Now, they don't normally do new state launches. And I think they said that if it wasn't for that, it would be around 400 million, which once again would have beaten their analyst expectations. But obviously, because they are now including the state launches, which they haven't historically done, that does put it a little bit higher. So that was absolutely fine. And that path to profitability begins and has begun. And this is going to, if they can do that, obviously that's going to be a massive reduction. And if they can start pushing that down into that 400 potentially, that'd be even amazing. But like we say, it depends on a lot of state launches. That's the really tricky thing. Obviously, we've got the new state launches coming out. We've got Maryland in Q4. We've got Ohio, Massachusetts coming in Q1 2023. And we've got Puerto Rico coming in Q3 2023. So we've got more states coming on, which is great. Obviously, they're going to be the revenue drivers coming up, and then they can start generating a bit of profit. The thing that will put, at the moment, DraftKings from 37% of the population to 45% of the population. So you can see we're getting to nearly halfway, which is starting to mature quite a bit. And obviously the states that have been active for quite a long time, they contribute profit. But it also suggests, you've still got, DraftKings has many years of growth drivers still left, with a lot of locations still to come online. So that was really good there to hear about the potential of new states in the pipeline, and also how big they are starting to get right now. Moving on to the next bit, monthly active users. So this was one thing that obviously we talked about. Barron's potentially said that this could have been the weak point. Monthly active users grew at 22%. Now this is historically a little bit lower than what historically has happened. DraftKings came out and said that in September that did go to 27%. So that has improved quite a bit. They said the reason why it's down is because it's quite volatile at the moment, because the sport calendar's all over the place. So like fans of the NBA, last year in 2021, because of the CV juggle sports calendar around, we had NBA this time last year. Now we don't have that this time last year. So that's jumbled a few things around, but everything is still looking good. And because of the volatility, DraftKings have never actually guided on monthly active users, because they said it's just so hard for us to predict. So that was all. I was happy with that. Average revenue per monthly active users was up 114%, which is insane. I don't think I've ever seen it this high. So the users that they have, they're making more money from, which is great. Net losses moved in a positive direction. That was 95 million better than last year, which is really great. Stock comp, they do get a lot of stick for stock compensation. For me, I have growth stocks are going to do stock compensation. If you can't get your head around that, you shouldn't be investing in growth stocks. They're going to do stock comp. It is a lot easier, more effective on the cash balance to save money. Now, there has been the question of whether the stock comp has got a little bit silly on DraftKings. Potentially, you could argue it has been a little bit high historically, but they did reduce that down by 49 million this quarter. So that was a very good improvement from last year. Sales and marketing last year was 303 million. This year it was 321 million. So there was only a 19 million increase in sales and marketing this year, which is actually really positive, because when you look at revenue was up 136%. So the sales and marketing here suggests DraftKings aren't pumping in sales and marketing to achieve revenue growth at the moment. And that's one of the big arguments the bear uses, the bears that have shorts on this stock. They, argue that it's only sales and marketing that's pumping up the revenue growth. This quarter totally smashed that out the window, because they hardly increased that marketing spend, and yet they drove revenue to insane levels. And that was another really positive in this quarter. Next thing, profit. What we've been talking about quite a lot this video. DraftKings now, the growth story's been there. They've delivered on the growth story. It's now about keeping that growth story going, and now it's time to drive to profitability. And it's always said this every earnings call, they've kept the same path of where they want to achieve profitability, and profit is now the key driver in the next 12 months. It's about keeping that revenue growth, but it's now time to bring them losses back up a little bit. And we're going to see that next year, and we're going to see that especially in 2024. And that was very key in this conference call. I've never heard Jason Robbins mention profit as much as what he did in this earnings call. I think he mentioned it at least a good 4 or 5 times in the first 10 minutes. And that was key to see what they're really going to start focusing on going forward. Q4 EBITDA, aiming for profitability or positive EBITDA. So we could be talking about in 12 months time, DraftKings achieving positive EBITDA. That's unbelievable, because if we do hit that in 12 months time, if we're hitting really good growth numbers still, and we start hitting positive EBITDA, all the bears, all the Wall Streets are going to go, oh crap, like we didn't think they could start pushing to profitability, and they're doing it. and they're still driving insane revenue growth, that could be a really key point, because at that point there, the leg that at the moment the bears are standing on, if that gets taken away, that's going to be a bit of a crusher for them. So that's going to be a really exciting time frame if they can do that. 2024 EBITDA positive, which we've heard them mention before. No capital needed. They've repeated this quite a few times, and now there's no capital needed to get to profitability with this business. And if you look at the numbers, you can see that with the way they're going to reduce the losses, and then obviously the revenue growth and the big cash balance they still have in the business. It looks very much true in that situation, and they've run multiple things of different changes, scenarios like a recession potentially of that happening. Gross margins were going to be, well, they're going to try and get 40% this year. Next year, they're going to try and move that to 43%. That'll be a really good improvement. And in the long term, my long-term aim for DraftKings is for them to push into a 50% gross margins. It looks like that is on the cards, which would be absolutely amazing if they get there. There was a lot of things in the conference call and press releases. I've tried to write a lot down. I'm sure there's a few more that I could have put on this list. But overall, my thoughts on this quarter was I was so impressed. I've seen DraftKings do, really good quarters, but this one stood out to me as a different level. The different level is that the EPS is now, moving into a positive direction where they're beating that. The revenue growth, it wasn't even close. That was an unbelievable beat. The guidance is just guiding higher and higher. And you're getting a triple beat like this, and then the stock's getting rewarded with a drop. It's just absolutely insane. The outlook is still good, even though it's conservative. They're starting to move to that path to profitability now in these next 12 months. They've got more states coming online. They're starting to come taking big amounts of market share. The net losses are coming down. The stock comp's coming down. Sales and marketing is staying pretty stagnant, and it's still achieving growth. The path to profitability is still very much what has been set out for many years ago, and it looks like they're on the way to achieve it. They're going to need no more capital. The gross margins are pushing into the way that I was hoping for them to push into, which is absolutely amazing. They're taking market share, and for me, it's just a phenomenal quarter. I was so happy with this quarter, and it's one of those that I said in the video yesterday, which was my prediction is DraftKings goes down. Even though they'll probably bring out solid earnings, and it's happened. I don't know what it is with Wall Street. They just don't seem to like DraftKings on earnings day, and it always kind of just gets sold off on earnings, and these earnings are good. And it was clear in the media. The media were scratching their head like, what's the reason that we say the stock dropped so much today? Because there isn't really one. And this was absolutely insane. And like I said, the slow sell-off in the day, it just seems like to me that there's just a lot of targeting pressure on retail investors to sell this stock off by dragging it down lower and lower and lower. And for me, I invest for the long term. I've had a long-term game plan on where DraftKings will be in the next 5-10 years. And it's exactly, if anything, it's achieving above what I wanted it to do. And that's absolutely amazing. It's amazing to see a stock achieve what you want it to do, and even probably outperform what you want it to do. And that's absolutely amazing. Now, it's probably one of those where you look in the share price, and obviously the bears are having the day, the shorts are having the day at the moment. The haters that live in the mum's spare bedroom are typing away in the comment section, and they're enjoying the moment right now. And yeah, it is, if you're a long-term investor, you've been in this for a while, you're seeing this pain, it's frustrating to see them coming out of a quarter and then the share price is rewarded like this. It can be frustrating, and don't get me wrong, I looked at this for when they initially came out and I went, it's dropping this much off an unbelievable earnings. It's frustrating. And then I sat back and I went, you know what? It doesn't really matter to me where the share price is today. It doesn't matter at all, because my game plan is built on what this is going to be in the long term. And in the long term, at some point, this will get the respect. It'll get the respect if it delivers the growth. It'll get the respect if it continues moving now to this path to profitability. And you know what? You know who's going to be the winner in the next few years? It's going to be who, has the guts to kind of, hold on to this stock. And if they deliver and you get the rewards, you'll be the one laughing. And if anything, look at the share price today, having a 20%, sell-off, which just looks absolutely ridiculous. it's probably just an opportunity to accumulate more shares at a better price. And I thought, you know what, if I'm going to get the opportunity right now to get this back down at some insane levels, 2 times sales or whatever it is right now, I'll take it. And I did that. I did buy some shares on this drop. As soon as I saw this stock down 27% after I finished work, I bought some shares because I thought this is insane. This was a great quarter and it doesn't deserve to be down. So I bought the dip. And I think at the moment it's delivering on what I want it to do. And it looks like to me, it's still very much going to be a winner in the long term. And it's very much going to take 30-40% of this very big TAM in the next few years. So I hope you enjoyed the video anyway, guys. Smash that like button. If you're new around here, subscribe. Hope you found the video helpful. And yep, still long DraftKings. Very, very good quarter and a ridiculous sell-off. Catch you in a bit.